rights issue. So this is an option on the side of the shareholder. The company sometimes it decides to give its shareholders an option of buying more shares. They are already existing shareholders. They are given a chance to buy more shares at a certain time. Maybe the company feels it needs more capital. So company will feel that we need to add capital. Instead of putting new shares to new members, they call the existing members during the AGM and they tell them, we want to raise a rights issue. We want to give you some rights. Such that we are going to give you shares, more shares, on the basis of your shareholding. So sometimes they give 2 for every 3 held, number 1 for every 2 held, equal to, and they can decide to give you in a certain way more rights, more shares. The option is normally given on pro rata basis. Well, when you hear the word pro rata in accounting, so if you are given like this 2 for every 3 held. So if you have 1,000 shares, now you're going to 500 shares, where you get more rights than her. And then these shares, currently, they have a market price. Unajua tuliona kuna ile power, si ndio? That is the value that it was floated at. But these shares, zikishakuwa floated to the public, what happens? We said that one of the characteristics of the company is that the shares are freely transferable, isn't it? That means if you are a shareholder of a company and you feel that maybe finances is continuing, you can sell your shares to another person without involving the company. Company ataita unauza shares. Wewe utauzia ule shares zako. Okay? Akupea pesa. Ufanye shughuli zako kama ni shughuli zinalipa. Yeye naye sasa ndiye atakuwa the new shareholder. Company itaendelea tu kuexist. Yeye company tulipea pesa yake kitambo, isn't it? Now these shares, because they are buying and selling, they are exchanging hands on a daily basis. Due to the market forces, now the reputation of the company, shares zingine zinaenda zinapanda bei. Okay? So ndio zinakuwa na kitu inaitwa market price. Okay? So you find that a share has, tuseme, a market price of 100 shillings. Okay? So that such that if this company sells the shares today, if you want to sell your shares today, you sell them at 100 shillings. Okay? If the company wants to float the shares to new shareholders, it will give them at 100 shillings per share. Okay? But in a sema, because you are our shareholders, we are going to give you at 80, at a price lower than the market price. And then we're going to allot you the shares on pro rata basis of 1 share for every 2 held. So if you have 2 shares, we're going to add you 1 more share to pay it. So if you have 2,000 shares, we're going to give you 1,000 more shares. Now to pay 80 times 1,000. Right. So the directors have decided to raise the rights issue, and they inform their shareholders that we are giving you these rights in this manner. And then you as the shareholders are the ones to decide. So one thing that is shareholder, most of them they take the rights. Okay? But there are others, if you are a shareholder, okay, and you have been allotted 1 for every 2 held, you had 2,000 shares, or may allot you 1,000 shares, you have to buy all the 1,000 shares. You have to exercise your rights. Okay? If you feel that it will not be possible to exercise that right that way, you can sell the shares to a third party. What will happen? Your 1,000 shares utaenda kwa broker. Okay? Shares zinauzwa, kuna brokers for shares. Okay? Utaenda kwa broker Nowadays, you just go to your CPA's account and you do the transaction. Can be able to do that, or you can go to the broker. You inform him. Then, here at the remember the 1,000 shares at market price. Now, we leave the company at the right price during the existing shareholder. So, we will make some kind of profit there. Yes. Other way you can do, you can ignore the rights. You may pay rights, you can buy 1,000 shares. You can ignore it because of the 2,000. When you ignore directors, you are the rights. Okay? So in that way, it is beneficial to a company. No, when they want to raise new capital, when they want to raise new shares or it is public offering, it is very expensive. Kuliko kupeana rights. You raise, ni wale new shareholders now you have their addresses. You just send them a circular and tell them they are giving you the rights. And I'm telling you, 90% will take the rights. The other 10% will sell the rights to the third party. And hakuna rights mtabakishia individually utafanya. It's very rare, especially nowadays. What we want to do. So, issue of debentures. If you get a question, and inasema the company issued debentures at this price, repay on this installment, the entries are the same. Okay? It is only the word shares that have been replaced with debentures. So the debentures, in real sense, the company will float them the same way as the shares. Okay? But when you buy the debentures, you become a debenture holder. This debenture to the company, it's not like the share capital. Share capital is equity. It will be there forever. But debentures, the debenture holders, they have given it as a loan. Okay? Yeah. It's not as an share capital. So the debentures, some of the debentures, they are redeemable after a certain time. And that is what we are going to look at. Redemption of redeemable preference shares and redeemable debentures. Remember, it says we have two types of shares. We have ordinary shares and preference shares. The issue of preference shares is the same. But when it comes to the accounting treatment during the operation of the business, preference shares are paid before. Okay? Before the ordinary shares. Then we also have redeemable preference shares. That means after a certain period of time, we are going to refund back their money. Okay? That is what we are going to look at. So redeemable preference shares. Redeemable preference shares are shares that can be redeemed, in brackets, bought back by the company from the shareholders, and then close the brackets. At later date, as stipulated in the terms laid down. During redemption, the following should be observed. Number one, the preference shares being redeemed must be fully paid. The second thing, because you are refunding money, there must be funds to cater for the redemption, provided from, and then you put a colon. One, new issue of shares. So sometimes they can decide to issue new shares. Then EPS emerect on the new shareholders to be a kulipa preference. Share redeemable preference to be a kulipa. Because redeemable preference shares is a very expensive source of capital. One thing, because the preference shareholders, they are paid a fixed amount of dividend. Number two, you can get this one from profit reserves. And thirdly, partly from the issue of new shares, and partly from the profit reserves. If funds, but you're still in number two, if funds are obtained from the profit reserves, they are first transferred to capital redemption reserve fund. This account replaces the redeemed preference shares in the financed by section of the statement of financial position. If the shares are redeemed at a premium, the funds to cater for the premium on redemption should be obtained from share premium account, if one exists, and 2, in the absence or insufficiency of share premium, then use the profit reserve. Illustration. During the year ended 31st December 2023, ABC Limited Company redeemed 1,000 shillings 50 preference shares at par. As at 31st December 2022, the statement of financial position revealed, then you put column, then you have other assets, bank, then ordinary share capital 50, redeemable preference share capital 50,000, statement of comprehensive income 70,000, and creditors 30. Assuming that column 1, to cater for this, the ABC Company Limited issued 1,000 shillings 50 new ordinary shares. Number 2, no new shares are issued to cater for the redemption. And 3, 500 shillings 50 ordinary shares are issued. Required: A, make journal entries to record the above information. B, prepare a statement of financial position as at 31st December 2023. Journal entries. To cater for this, ABC Limited issued 1,050 shillings ordinary shares. So, you debit bank to receive this. And then you credit ordinary share capital. This is for what? To record issue of shares at par. You debit redeemable preference shares capital account. And credit to record redemption. Debit profit and loss account, income statement, and credit capital, redemption, reserve fund. This one is to transfer, or to record transfer of funds to the. Remember, he said that when we want to redeem the shares, we transfer the funds to the redemption reserve fund. So to cater for this, let's assume that our question says that we redeem the shares, assuming number one, that we only issued 1,000 ordinary shares to cater for that. Okay? We're using assumption 1. So when we use assumption 1, this is how we redeem the shares. Okay? And when we redeem it like that, and we're supposed to show the statement of financial position, as at 31st December 2023. We will have other assets, how much? Tuko pamoja? We are doing assumption 1. We have bank itakuwa imebaki ngapi? It will have no change because our bank account is this one, sindio? Balance iko na ngapi? 70, isn't it? Then debit this. You have issued new share at 50,000, sindio? And then we have share capital had a balance of what? 50,000, sindio? Then we have issued another one here, isn't it? We are doing assumption 1, 50,000. Okay? Then, redeemable preference share capital, it has a balance of how much? 50, isn't it? Okay? Then what happens here? This journal, you debit this one, redeemable preference share capital account. Are we together? And credit bank, Stumelipa. This is redeemable preference share capital, 50,000, isn't it? Okay? Sindio? Close the account. How much will be here? Yes? 70. How much will be here? How much will be here? Yes. Cindy, make the statement of financial position now. So the bank will be how much? 70,000, isn't it? You get a total of what? 20? Is it 20 or 200? 200,000. Then we go to the finance by section. This is for equity and liabilities. So you have to instead of finance by. We have ordinary share capital. How much? 100, isn't it? Then, statement of comprehensive income statement. Change Creditors 30. That is how our statement of financial position will look like after we have redeemed preference shares using issue of new ordinary shares. Isn't it? Suppose we use no new shares. No new shares were issued to cater for redemption. So this means we are going to use what? The reserves. Remember, our notes ianza pale mbele. Si ndio tulisema? Yeah. Let's assume no new shares were issued. If you look at our notes, during redemption, the following should be observed. Number 2, there must be funds to cater. If the funds obtained from profit reserves, they must be transferred to what? To CRF. To copy for your notes, number 2. We are going to use what? The profits. So that means we are going to less something from the profits. We transfer it to the CRF. Okay? Our profit and loss account looks like this. Sindio? Our income statement. Ikiwa in this format, income kwa iko wapi? Sikosaidii. Mkifunzo hivyo, mkifunzo hivyo. Let's just 70,000. You are using this money to pay what? To pay the redemption of preference shares. Okay? So we are going to remove this money here. Okay? And transfer it to CRF. So, how many shares are to be, how much is it to be transferred? How much shares are being redeemed? $50. So, we are going to debit what? This is the double entry. So we are going to debit the income statement of comprehensive income, $50. And then credit capital redemption reserve fund, $50. So this is to record what? To record transfer of funds to CRF. That is the first thing that you should do. Okay? Then, now because you have transferred this amount, tunataka tufanye nini? We want to pay for redeemable preference shares, which we have a balance of how much? Preference share capital, 50,000. Bank has a balance, 70,000. So, we debit here. And credit. Debit, redeemable, preference share capital account with 50,000 and credit bank. This is to record redemption at par. If we have to get our statement of comprehensive income at this point. As at 31st December 2023. We will have other assets. How much? 130,000. Then we have bank. Bank. $20. Then we will have bank 20,000. This one will give us what? 150. Then equity and liabilities. We have ordinary share capital. How much? Ordinary share capital haikubadilika. Then we have statement of comprehensive income. Statement of comprehensive income, we have 20,000. Then we will now have another source of capital, which is the CRRF. Itakuwa na balance. Okay? Which will be 50,000. Creditors 20. That you should give like 50,000. Suppose the shares, the redeemable preference shares were redeemed, but now they are redeemed using issue of 500 shillings 15 ordinary shares. So it's doable. You do it. I want to see the journal entries and also the statement of financial position, and you can also show this, the part of the workings, and that is the end of the issue of shares. Those are the entries. You might get a chance of